Greetings and hello. I'm Zainab Omar, and in this video, I will be discussing the concepts covering the definition of venture capital, corporate venture capital, and private equity, the historical background of corporate venture capital, obstacles faced by venture capitals and their possible solutions, the differences between venture capital, corporate venture capital, and private equity, as well as a brief review of chapters 1 to 4 of the book titled Venture Capital Deals Be Smarter Than Your Lawyer and Venture Capitalist, written by Brad Feld and Jason Mendelson in 2016. To start with, what is a venture capital? According to Levinson 2014, venture capitalist, also referred to as VC, invest in young startup companies with growth potential in return for equity stake in the firms. This is because new startups find it difficult to source funds from the banks or the capital market, so they turn to venture capitalists for investment. On the other hand, a corporate venture capital, or CVC, is a limited liability corporation, for example, Google Ventures. They also invest in startups, while private equity invests in mature companies to improve the revenues of those companies. The differences shall be discussed in detail later. Now let's go back in history and discuss the origin of venture capital, as well as how the concept evolved over time through different economic conditions. Golden et al. 2019 state that corporate venture capital has its origins from 1914 in the American history when a chemical producing company known as DuPont invested in General Motors, a manufacturer of automobiles. Scholars divided the history of CVC into four eras. The first era is called the conglomerate era from 1960 to 1977. This is the period after the Second World War when the American economy was booming and thriving. Therefore, there was a lot of CVC activities, especially in the pharmaceutical industry. However, in 1973, the OPEC oil crisis triggered a recession and the conglomerates drastically reduced their CVC activities. This led to the second era, known as the early Silicon Valley era, between 1978 to 1994. There was a peak in the computer technology investments, not only in the United States of America, but also in the European and Asian markets. Unfortunately, this new boom was disrupted by the stock market crash in 1987, which led to a series of macroeconomic difficulties, thereby affecting negatively CVC activities. The third era is characterized by the famous dot-com bubble and bust between 1995 to 2006, when the internet became commercialized. Media and advertising startups became the new gold for Silicon Valley. The fear of being left out left many corporations to engage in very risky venture capital activities. In 2001, just like the previous eras, the dot-com bubble burst, with enormous losses. Over $9.5 billion was recorded. CVC activities declined just as seen in the previous eras. The fourth and final era is called the unicorns, which started from 2007 and lasted up to 2019. With the advent of smartphones, cloud computing, and social media platforms. Facebook, for example, received a $250 million investment by Microsoft to correct the perception that corporate venture capitalists only invested in good times and retreated in crisis, thereby not protecting the interests of the startup companies. Other corporate venture capitalists followed suit with better talented investment personnel who avoided the mistake of falsely bidding up the valuation of startups, which was the origin of the problem during the dot-com bubble. So, there are four major players in venture capital, and I shall be discussing them according to hierarchy from the most senior to the least. The highest ranking player is the managing director or the general manager, which can also be titled as the executive managing director or the founding general partner. These people sit on the board of directors and take the final decisions. The second highest ranking players are called the principals or directors, who have some power, but they need the managing directors to finalize on deals. The third highest ranking players are the associates, who scout for new deals, assist in existing deals, and write up official memos for investments. They are the most familiar with the capitalization table, also known as the cap table, which is a spreadsheet that defines the economics of the deal. Venture capital firms offer a 2-year associate program in which successful graduates either become principals in the firms, join a portfolio company, join a business school, or start up their own business. The least ranking players are known as the analysts. These are usually fresh graduates whose job description include writing a lot of memos, crunching the numbers, and their office is usually located separate from the others. It should be noted that some staff of corporate venture firms have complimentary cards that bears partners on it, but this doesn't mean that they are partners. It means that they are not high-ranking officers, but rather junior deal professionals that engage with sales, recruitment, and operations of the venture capital firm. There are also venture capital or operating partners who are experienced entrepreneurs and have a part-time relationship with the venture capital firm. They assist in managing investments. Similarly, there are entrepreneurs in residence or EIRs. They exist. They are also part-time members of venture capital firms for 3 to 12-month period. Some venture capital firms pay these entrepreneurs in residence, while others just provide them with free office space to work with. Now, let's discuss financing. Series of financing rounds are available for a firm. Each financing round is lettered alphabetically and hyphenated with a number in some cases. For example, early or initial investment are called pre-seed or seed rounds. Then we have Series A, Series B, Series C, Series D, and so on. For a series with multiple cycles, firms can have, for example, a Series B fund, and then any additional funding makes it a Series B2, Series B3, Series B4, and it goes on and on. It is important to note that early stage companies usually have the pre-seed and Series A funding, while mid-stage companies have a Series B and Series C, leaving Series D for late-stage companies. There are different types of venture capital firms according to the different stages and funding. First is a micro venture capital firm, which is a relatively small company with usually one general manager and who is usually an angel investor and invests no more than $15 million capital per fund. These firms invest in early stage companies along with friends and family. Second is the seed stage funds, which are bigger than the micro venture capital funds with up to $150 million per fund. According to Feld, 2016, they rarely invest past a Series A. Third is the early stage funds, which invest between $100 million to $300 million. Fourth is the mid-stage funds that invest between $200 million to $1 billion in Series B and beyond, and they are also known as the growth investors. Fifth and last is the late-stage funds, who invest just before an initial public offering. These are associated with large banks or sovereign wealth funds. However, it should be noted that it is not uncommon for a billion-dollar fund to invest in early-stage series. Therefore, it is paramount for entrepreneurs to identify the type of accredited investors they need depending on the stage of their company. A syndicate is a group of investors such as angel investors, super investors, strategic investors, law firms, or any party that participates in the equity purchase. A syndicate could have a lead investor or co-leads who take the lead on investment negotiations. Let's not forget that lawyers also play a very crucial role, especially for the entrepreneurs who raise funds occasionally. Venture capitals are very experienced, So entrepreneurs need good lawyers to navigate successfully through negotiations. A bad lawyer could ruin all the deals. A startup lawyer's reputation makes a big statement. Legal fees vary from $5,000 up to $40,000 depending on the startup stage. Entrepreneurs should also consider having experienced mentors who can genuinely help, not advisors that pray or seek for a share in the deal. Some mentors have been known to become angel investors, and they are truly and genuinely interested in the growth of the company. Also, entrepreneurs should ask for financing for what they need, not for an amount in excess. Because if startups need for funding above what they actually need, this might put a venture capitalist. So now let's discuss some elements of the term sheet. Entrepreneurs should know that investors love to be part of an oversubscribed round of funding. Using a private placement memorandum is considered by Feld to be a weak approach by a startup. It indicates that the startup had unsuccessful attempts previously or is getting bad advice from advisors that are probably charging for advisory fees. Feld also states that a detailed financial model predicting a very fruitful future is mostly wrong. Providing a demo is a good starting point. So if entrepreneurs or startups have a sample demo of what they would like to develop of their product, it is a good idea to have something to show the venture capitalists. Then, entrepreneurs should also prepare a successful pitch, make sure all the documentation has received due diligence before the fundraising occurs. A startup needs to close a deal either by signing the term sheet or signing the definitive documents and agreements and getting the cash. Venture capitalists then receive equity, mostly in form of preferred stock. Next, I shall be discussing obstacles faced by venture capitalists. Venture capitalists face the problem of information asymmetry, which means that the entrepreneurs are concealing or not disclosing relevant information to the venture capital. Others include diversion of funds by entrepreneurs and capital gains tax. To resolve some of these issues, some venture capitalists have resorted to round tripping. Round tripping means they basically use tax havens such as some islands like Singapore or Cayman Islands to avoid paying tax. Rumesh and Anomaly 2020 suggest that venture capitals use convertible preference equity to mitigate agency costs. In addition, convertible securities are known to mitigate manipulated signals to avoid extremely risky ventures. All these measures are taken by venture capitalists to avoid unsystematic risk. Although venture capitalists, corporate venture capitalists, and private equity share a lot in common, there are major differences between them. They all have a common goal of creating value for their limited partners, but they differ in the way each goes doing about it. Venture capital funds offer their expertise support to startups in return for a high return on investment, which is usually measured by the internal rate of return, while the corporate venture capital focuses more on creating strategic value by sharing their technological know-how and synergizing portfolio companies. In terms of governance, venture capital seek control in accordance with the proportion of funds they invested. Corporate venture capitals, on the other hand, play a more advisory role. The startups can benefit from the corporate venture capital, corporate brand, goodwill, customer networks. According to Feld 2016, corporate venture capitals invest to also have access to patented technology, distribution channels, market share, or just to outcompete another corporate venture capital. Furthermore, venture capital or corporate venture capital differ with respect to the investment time frame. A venture capital usually invests between 7 to 10 years before exiting, Well, the corporate venture capital can last for a very, very long time. According to Wait 2006, there is a potential risk when a startup is backed by a corporate venture capital whose leadership can change at any time and can affect the objectives of the firm. When a startup makes a capital call to a corporate venture capital, many factors come in play, and these factors can negatively affect the availability of funds to be issued or additional funds to be issued. Some of these factors include the stock price, the balance sheet, or the external economic shocks. Another difference between venture capital and corporate venture capital depends on the exit strategy adopted by each. With a venture capital, a startup can exist by going public through an initial public offering or IPO. On the other hand, a corporate venture capital can exit either by buying out the startup or the startup becoming an acquisition target to another corporate venture capital. Startups need to be very careful because sometimes they can develop a product which can become in competition with the corporate venture capital's products elsewhere. So, it is very crucial for an entrepreneur or startup to have a venture capital at the early stage. So venture capitals are crucial at the early stage of a startup and are known as being enterprise nurturing, while corporate venture capitals assist startups in building commercial credibility and capability, who are known as the commercial builders. Both are different, but both add values that are complementary. Thank you.